All right, this is the part two of the conceptual reframing, that is the currently shown conceptual framework. All right, and in this, first of all, we will gonna discuss about the recognition and de-recognition of assets and liabilities. Okay. Recognition and de-recognition. Right. So, uh, the board has confirmed a new approach to the recognition, which requires a decision to be made, with the reference qualitative with the reference of the qualitative characteristics of financial information. Information, right? Uh, The board has confirmed that entity should recognize an asset or liability and any related income, expenses, changes in equation if such recognition provides user of financial statements where, right. So an entity can recognize asset, liability, income, expense, or changes in equity. When can they do so? They can do so, number one, if the relevant information about the asset or liability, they can recognize with the relevant information about asset, liability, income, expense, or changes in equity. Number two, a faithful representation of the asset or liability. Asset or liability and any of income or expenses or changes in equity. Number three, information about the results and benefits exceeding the cost of providing that information. Well, a key change to this is the removal of probability criteria, right? So now probability criteria is removed. Probability criteria is removed. This has been removed with the different financial reporting standards apply criteria. For example, apply probable, some virtually certain, and some reasonably possible. This also means it also specifically prohibits the recognition of assets with the low probability of an asset of an inflow or outflow of economic resources. The key point here relates to relevance, right? The relevance. The key point is related to the relevance. Right, if the probability of the event is low, this may not be the most relevant information. Right, if probability is low, that means it says that sorry, the if the probability of the event is low, this may not be most relevant information. Right. The most relevant information about the potential magnitude of the item, the possible timing, and factors affecting the probability, right? So mm, uh, the possible timing and factors do affect the probability of the information, do affect the probability that is gonna be probable or not, if it's timing and its factors hitting it or not, right? Finally, major change in day recognition. No, the D recognition, right? As far as D recognition is concerned, this is an area not previously addressed by the framework, but the framework states that D recognition should aim to represent faithfully both. Number one, the asset and liabilities retained after the transaction or other event that led to D recognition, right? The asset and liabilities retained after the transaction, retained after the transaction or other event that led to D recognition. D recognition, including any asset, liability acquired, incurred, or created as part of the transaction or other events. Number two, the change in the entity's asset and liabilities as a result of that transaction. or other event. So far so good. All right, then we have the measurement. So the measurement. The measurement basis must be taken into account the key characteristics of the financial information, which include the relevance, number two, the faithful representation, and more particularly the characteristics of the element contribution to the cash flows, characteristics of the element of the characteristics of element, the contribution to cash flow, due to economic activities, and measurement uncertainty, and measurement uncertainty and cost constraint. The balance is needed. All right, it says that the balance is needed between the entities, the flexibility to provide relevant information that faithfully represents entities' assets, liabilities, equities, incomes, expenses. To require the information uh, should be comparable both from period to period and across entities. So the first measurement base discussed is historical cost. Okay, the historical cost accounting treatment is unchanged. It is unchanged. Right, but framework now explains that carrying amount C dot A means the carrying amount of non-financial non-financial items, not instruments, but items, non-financial items held at historical cost, held at historical uh, cost should uh, reflect, I mean, should be adjusted, right? Why it need to be adjusted? Just because it need to be adjusted over time to reflect the usage in the form of depreciation or amortization, in form of depreciation or amortization, right? So far so good. The carrying amount can be adjusted to reflect that a historical cost is no longer recoverable. Impairment financial items held at historical cost should subsequent changes such as interest and payment following the principle reflect often reflect uh, such as interest and payment following the principle often referred to as amortized cost. All right. It also says the point to be noted over here that historical cost is no longer recoverable. Right? Shocking news it is. That means there is no impairment. No impairment, right? Financial items, as far as the financial items, financial assets, uh, held at historical cost, it should reflect changes. Subsequent changes such as interest and payments, such as following the principle which has been referred to as amortized cost. Okay, the framework also describe measurements of current value. Okay, the measurements of current value are fair value, number two, value in use, or you can say fair value for liabilities, and number three, the current cost. Right, these are the three bases for the measurement of current value. Okay, as far as the fair value is concerned, fair value is same as before, right? Continue with it is the price in an orderly transaction. In an orderly transaction between market participants. All right. It is defined as entity specific value and remains as the present value of the entity expects to derive from the continued use of an asset and its ultimate disposal. Ultimate disposal. Right. Now, what is the current value? Oh, sorry, the current cost. Current cost is different from fair value and value in use, from fair value and value in use, right? As the current cost is an entry value. It is current cost is entry value. It looks at the value in which entity acquires the asset, right? Acquires the asset or incur the liability. At current market prices, whereas fair values and value in use are current, exit values focuses on the value which will be gained from the item, right? Again, relevance is the key issue over here. Uh, it is a key issue over here. The relevance is the key issue because the framework says that historical cost may not provide relevant information about assets for long period of time and are certainly unlikely to provide relevant information about derivatives. In both cases, it is likely that some variation of the current value will be used to provide more predictive information to users. Conversely, the framework suggests that fair value may not be relevant if items are held solely for use or to collect contractual cash flows alongside this. Right, so the framework specifically mentions items used in the combination to generate cash flows by producing goods or services to customers. Now, the last thing which we have to look at is over the presentation and disclosures. Presentation and disclosure is the new section which contains the principles relating to how items should be present and disclosed. Well, firstly, principle is that income and expense should be included in statement of profit or loss. Well, that's not a new thing, right? But further, it says that unless, no, that's a new thing. Unless relevance or faithful representation would be enhanced by including change in current value of asset or liability in OCI. Then the second point is related to the recycling of items in OCI into profit or loss. IS1 presentation of financial statements suggests that this should be disclosed should be disclosed item to be if item to be reclassified or not. Done, done, or done. Then the recycling of OCI is in continuous, and some commentators argue that all OCI items should be recycled. Alright. So regarding the OCI, that some says that some items in OCI should be continuous, right? So not, and some says that all OCI items should be recycled. And others argue that OCI items should never be recycled. So the framework contains a statement that incomes and expenses included in OCI recycle when doing so would enhance the relevance of faithful representation of the information. OCI may not be recycled uh, if there is no clear basis for identifying the report in which recycling incur should occur, right? And that's it, folks. I hope you get this video, and this is very important to not miss. Take care.